Good afternoon, everyone. Over the last 3 days, the Monetary Policy Committee reviewed evolving global and domestic macroeconomic developments. We noted that global economic activity and trade has continued to expand, though there has been some easing of momentum since our April meeting. Inflation pressures have emerged in some key advanced and emerging economies, driven in part by rising commodity prices, especially those of crude oil and petroleum. Markets have been driven mainly by and geopolitical developments. Emerging market currencies have, by and large, depreciated against the US dollar. On the domestic front, GDP growth for 2017-18 has been revised and estimated at 6.7%, backed by an all-time high production of food grains and horticulture and geopolitical developments. Emerging market currencies have, by and large, depreciated against the US dollar. On the domestic front, GDP growth for 2017-18 has been revised and estimated at 6.7%, backed by an all-time high production of food grains and horticulture, strengthening of industrial growth, and resilient services sector activity. For 2018-19, the forecast of a normal southwest monsoon augurs well for our agricultural sector. In manufacturing, capacity utilization has increased, and the manufacturing PMI remained in an expansionary mode for the 10th consecutive month in May on the back of new domestic orders and exports. In the services sector, various high-frequency indicators suggest improving performance. Investment activity is expected to remain robust even as there has been some tightening of financing conditions in recent months. Both rural and urban consumption remains healthy and are expected to strengthen further. Accordingly, the MPC decided to retain the projection of GDP growth for 2018-19 at 7.4%, with risks evenly balanced around this number. Retail inflation, measured by the year-on-year change in the consumer price index, rose sharply to 4.6% in April. Even excluding the estimated impact of an increase in house rent allowances for central government employees, headline inflation was at 4.2% in April. At the MPC's meeting in early April, the price of Indian basket of crude has surged from $66 a barrel to $74 a barrel. This, along with an increase in other global commodity prices and recent global financial market developments, has resulted in a firming up of input cost pressures and persistence in the higher CPI projections for 2018-19. In the MPC's view, the price of the Indian crude basket imparts considerable uncertainty to the inflation outlook, both on the upside and the downside. Taking these effects into account, the projection of CPI inflation for 2018-19 is revised to 4.8 to 4.9% in the first half, the first 2 quarters of 2018-19, and 4.7% in the second half for both quarters, including the HRA impact for central government employees, with risks tilted to the upside. Excluding the impact of HRA revisions, CPI inflation is projected at 4.6% in the first half and 4.7% in the second half. On a careful assessment of all these factors, the MPC decided to raise the policy repo rate by 25 basis points and retain the stance of monetary policy at neutral. The committee reiterated its commitment to keep inflation at the target of 4% in the medium term and to remain vigilant on how actual inflation unfolds. Underlying the MPC's decision was the concern that headline inflation has been sharper than anticipated and that it has remained above the target of 4% for 6 months in succession. Over this period, the MPC maintained status quo on the monetary policy stance in order to carefully evaluate and monitor how the various risks to inflation have evolved. Moreover, An abiding concern of the MPC has been that the impulses of growth were nascent and taking root. In its current assessment, domestic economic activity has exhibited revival in recent quarters, and the output gap has almost closed. Investment activity, in particular, is recovering well and could receive a further boost from resolution of distressed sectors of the economy under the Insolvency and Bankruptcy Code. It is in this context that the MPC decided to raise the policy rate after a prolonged pause. Going forward, we will continue to be cautious and remain vigilant, in which the balance of risks around both growth and inflation play out. I'll now request Dr. Acharya to say a few words. Thank you.
Thank you, Governor. Good afternoon, everyone. First, I'll explain briefly how the recent inflation prints have affected our projections for the year. While the April and May prints have more or less been in line with our April projections, there has been an important compositional shift. Inflation, excluding food and fuel, has hardened sharply, driven by a variety of factors laid out by the Governor, such as the oil price rise and input cost pressures. This hardening has imparted persistence into higher inflation projections for the next year. In contrast, food inflation has remained benign, and the typical seasonal pickup that one sees around this time has been delayed. This has put some softening into the short-run inflation projections. Overall, however, the ex-HRA inflation projection for the second half of 18-19 has risen by 30 basis points from 4.4% to 4.7%. And in parallel, growth indicators appear to suggest that economic revival is now on a sound footing. Given the MPC's commitment to maintain headline inflation at target rate of 4% on a durable basis, the time seemed right to the committee for raising the policy rate by 25 basis points. Second, let me turn to liquidity. As expected, the redemption of market stabilization securities in March and the normalization of bank balances have added to liquidity in April. However, higher than expected increase in currency in circulation during both April and May, as well as the Reserve Bank's foreign exchange operations during this period, have negated much of the system-wide increase in liquidity. In other words, liquidity remained in neutral zone during March and April, even though it switched back between deficit and liquidity during several weeks. In terms of magnitudes, the daily average liquidity absorption by the RBI, this is the excess liquidity that RBI mops up as surplus liquidity from the system if the net LAF operation is positive. During the month of May, this was 0.12 trillion rupees or 12,000 crores as compared to 0.5 trillion or 50,000 crores in April. The weighted average call rate at which money market participants lend to each other overnight on an unsecured basis, and which is a good proxy for liquidity conditions in the economy, this rate has remained soft, on an average 5 basis points below the policy rate during April to May 2018. It was 3 basis points below the policy rate during Jan to March 18. At the time of last policy, we had indicated that liquidity is likely to remain moderately in surplus during the first half of fiscal year 18. The few days of June so far have been in comfortable surplus liquidity condition of 0.9 trillion or about 90,000 crores. This has been driven by an increase in government spending. However, the currency in circulation expansion has remained above trend, and looking ahead, advanced tax outflows in mid-June would also reduce the system liquidity. So we'll watch these evolving liquidity conditions to determine our choice of instruments for both transient and durable liquidity management. Third, I'll just briefly touch upon a few developmental policies. The details are in the Part B or the supplemental and developmental policies that you have. One, in the liquidity facility that RBI provides, what is called as the LAF facilities for qualifying market participants, presently RBI applies a uniform haircut of 4% against eligible central government securities collateral and 6% for the eligible state development loans. This is in contrast to international standards where the haircut typically depends upon the maturity of the collateral because that reflects the market risk that the collateral is going to have. So starting August 1st, 2018, the haircut that the central bank charges at the LAF will depend upon the residual maturity of the eligible collateral. For central government securities, it will range from 0.5 to 4%, depending on 5 different buckets of residual maturity, and for state development loans in the range of 2.5 to 6%. And with a view to incentivizing the state governments to get their state development loans, get a public rating for them, we will offer a discount of 1% on rated state development loans for similar maturity compared to unrated state development loans. Second, we are planning to come out with a consultative draft regulation for market abuse regulations. At present, we have what are called as codes of conduct. These are sort of voluntary agreements within our market participant bodies such as FIMDA or FEDI. To be in line with international practices, I would say the best global practices, we plan to implement some enforceable regulations to essentially incentivize the code, that the code is being adhered to. And lastly, you might recall that in October 2017 policy, a high-level task force had been put in place under chairmanship of Mr. Deusthali to assess if and how a public credit registry could be created for India. The task force has submitted its report on April 4th. It will be released on the website of RBI today. And they have recommended that to foster better access to credit and strengthen the credit culture in the economy, the Reserve Bank should set up a public credit register. We've decided to go ahead and constitute an implementation task force that will guide us on the logistics for the next steps. I would just stress that public credit registry is one of the important ingredients of the ease of doing business index of the World Bank. Thank you.
Thank you, Dr. Acharya. May I request Mr. Vishwanathan?
Thank you, Governor. I'll highlight a few issues that have been indicated in Part B, not all of them, but some of the more important ones, and not exactly the order which appears there. This on the MSME exposure. In February 18, we had allowed the banks and NBFCs to reckon a 180-day norm for classification of NPAs in the smaller MSMEs, that is with exposure up to 250 crores. That was limited to the GST registered NBFCs. Now we have decided to extend it to the non-GST registered NBFCs, but there is, as we go forward, an incentive for getting registered because there's a phase-in of going back to the normal 90-day norm in case of those which are getting registered, but for others it will come back immediately if they don't get registered by 31. So we believe this we are doing because we believe that formalization of this sector is beneficial for financial stability. The second part, of course, is this conversion of urban cooperative banks into small finance banks, because there's been a demand from some quarters that we must allow them to cooperatize. And we believe that small finance banks are also having the same mandate of financial inclusion as part of their fundamental business model. So we will come out with a detailed scheme on this conversion from small finance banks to urban cooperative banks, small finance banks. Incidentally, if you recall, the High Power Committee under Mr. Gandhi, which went into the urban cooperative banking sector, had recommended that such a thing should be done. Another is on the LCR. We have SLR and LCR, so we have been allowing a carve out from the SLR, which can be reckoned for SQLs for LCR as well. So we have now raised that carve out from 11% to 13%. So 200 basis points increase there to use the liquidity.